Hi there, Chris Weston, Head of Research at Pepperstone. We're going back inside markets. We're going to have a look at markets from a 360-degree angle, across markets, cross asset basis, and try and make sense of this crazy world of trading that we're in at the moment. And we have seen volatility pick up. And we've got two major cross currents that are really feeding into the narrative at the moment. One continues to be inflation. It continues to be the data that's coming out in December. It continues to be whether or not what the Fed are going to do at the December FOMC meeting and throughout 2022. And against this backdrop, we now have Omicron, which is the new situation that markets have to try and price risk in. The question that we were asking a couple of days ago, we were getting some clarity, some belief that the vaccinations would hold up against the new strain that we're now seeing spreading across the world, and especially in the severe cases, they should continue to hold up. Now that situation has been muddied a little bit because of what we've heard from the Moderna CEO. And that makes pricing risk very difficult. It makes us trying to understand economics in 3, 6, 12 months very difficult in that situation. Of course, those two things do collide in that capacity. Let's have a look at markets over the last week, just to get a sort of a picture. And you can see in the FX markets trading against the dollar, the Japanese yen's been the best place to be. So obviously in this situation where you've got drawdown coming through in equities, high volatility in crude, massive volatility in crude, and you've got the VIX index now trading at 27%. Where's the best place to be? Of course, it's going to be the Japanese yen. It is the Mac Daddy of safe haven currencies. The Swiss franc is doing quite well, up 1.4% against the US dollar. So the Swiss has been, having a bit of a move against the whole complex, really, and that's something that's going to concern the Swiss National Bank. So on Monday, we're going to get the sight deposits coming through the Swiss National Bank. Are they going to increase? What does it mean? Does it mean that they've been infiltrating the FX market, selling Swiss franc into the open market? That's something that we're going to be watching. But I do believe that over a longer period of time, there is no currency in G10 that's more overvalued on traditional valuation metrics than the Swiss franc. If you're looking on a real effective exchange rate basis or a nominal exchange rate basis, or if you're on a behavioural exchange rate basis, which is one the sell sides are now peddling along, the Swiss franc is grossly overvalued. Actually, conveniently, on the downside, the most oversold or undervalued currency is the Aussie dollar. And what these valuations tend to see is a situation where you get mean reversion. That mean reversion tends to take about 2 years to play out. And obviously, in this environment of high vol, we're not going to see mean reversion anytime soon. We're not going to see buying in the Aussie dollar, an environment where the VIX is trading at 27%. But you can get a general sense of what's been going on over the last 5 days. Let's have a look at how this feeds into the gold market, because ultimately, as we always talk about, if we're taking positions long of gold, then really we want to do it in the weakest currency, and if we want to be short of gold, we want to do it in the strongest currency. And we can see there that the gold price in US dollar terms is down 59 basis points over the last 5 days. So a pretty flat performance. It's starting to base out now. If you want the vol, you've got to go into palladium. I think that's where the big moves have been taking place. But if you want vol, go into the crude complex. And that's something that we can touch on in a second. Let's go quickly to the charts and actually see how this resonates before we go into some of the other influences. Because the way that I like to play gold in this environment, in dollar terms, let's take it in dollar terms, because of course that's where we see all the flow, isn't it? That's where we always see all the flow in XAU, USD. You can see a situation where gold price has broken this uptrend. You can see these series of higher highs. Now they've obviously given way. What we've done is we've seen on the daily chart the price moves into sort of this former resistant level, this spike out area level around 1811, and you can see that look at the candles, look at the wicks that we've been seeing there. Big moves and rejections, big moves, rejections. And you can see there's obviously a lot of supply coming into the market on any kind of bounces. That needs to change. That market's dynamic needs to change to take long positions in this. What we are starting to see is these conditions are making a base around 1769. That interests me. Now, the way that I want to play this in a short position, I have no position as it stands at this point, we can have a look at the dollar in a second, but if this was to break, just without taking any kind of understanding about what's happening in the currency complex and taking this on the daily chart, we can obviously take this down, but just having an oversight, I think it's pretty clear that into sort of 1769 there's a huge amount of support. If this gives way, especially on a closing basis, I think short positions are the way forward. I would therefore start with a small position, and I would look to add if this position went my way. Okay, it's oversold. You have a look at any of the Oslo, but what can be oversold can stay oversold. in this dynamic. And I think until price can close above this 5-day exponential moving average, people are going to be looking to sell rallies. And I think I'd use that as a guide to define my position. If it breaks through 1769, then I think I want to be short, closing that short position on a daily close above the 5-day exponential moving average. But I only really want to be short if we can see price give way around 1769. I want to take a small position and increase the size as the trade works in my favor through 1761. Again, I want to look to add to those positions and do more of what's working. Now, what I think is interesting here is if we were to see some buying kicking, it can close above the 5-day exponential, and that would probably coincide with a slightly weaker dollar. And we can start moving back above 1794 around these kind of areas around here, then I'd probably be looking to add to that as well. So again, starting off on a small long position, if we did start seeing this move up and break above the 5-day exponential, you're probably putting a stop loss just below 1769, seems the obvious place to cut out half position and then fully out the position through 1760. So really you're taking a little bit of risk on there. You can define that risk and how much you're taking on, and then really look for a move back into 1812 and see how price reacts around there. But I do want to wait for the market to push me into a trade. So no position at the moment. Again, just waiting for the price to break through these levels and then look to take a small position on add, and really just see what happens. But again, that really depends on what happens with the US dollar in this situation. So let's have a look at that dollar position. And immediately I'm going to have a look at the Dixie, because again, this is 57%. Run by the basket is weighted towards the euro, and you can see it's making lower lows and lower highs. So it's difficult to take a really bullish view on the dollar in this situation, because we are sort of just meandering a little bit lower. I think we're going to have to see a lot of this data coming out topside for that to move. And if you have a look at euro dollar, you can see this has been grinding higher a little bit there. So it's in this kind of nice channel. I could draw a channel here, but you can see that we're making these high lows, and that suggests that the path of least resistance in euro dollar is probably a little bit higher. And people say to me, Chris, we've got volatility picking up, you've got credit spreads widening, huge volatility coming through in the commodities markets. Why is the euro rallying against the dollar, especially as COVID trends in the US are pretty much non-existent when it comes to, at least when it comes to Omicron, and we're seeing restrictions being placed in Europe? Well, this is the fact that it is a funding currency. It is the funding currencies have done very poorly in a time of low volatility, higher interest rates. People want to get paid to be in a position. So you go into carry. That carry trade has just been taken to the absolute woodshed in this higher volatility environment. And the funding currencies which have funded that carry have just worked beautifully. And that means we're now starting to buy the yen, the Swiss franc, and all those funding vehicles like the euro. What we've also seen, if we go back into the bond markets here, which I'm going to focus on a lot because I think it's just where you need to be looking at the moment. Have a look at nominal spreads of US Treasuries over German 5 years. And I've chosen that part of the curve because it really encapsulates sort of medium-term interest expectations. So what you can see here is that the 5-year yield spreads in the US, the yield premium has been rising relative to Germany, and that means that you want to be buying US dollars in that environment. Now that opposite is true, and you can see that nominal Treasuries, that spread has gone from around 199 down to about 181. That's just enough to take some of the heat out of the carry move, effectively the yield differential move, and take us back into euros. You can also see that on a real basis, and you can see that the 10-year real rate, German. I flipped this the other way around, but you can see the white line here is effectively the 10-year German real. So it's been adjusted for inflation expectations, real rates relative to US real rates, and you can see as this has been going up, this is meaning that German real rates have become less negative relative to the US, and you can see again that the euro's rebounded on the back of that. So forget about what's happening in COVID trends in this situation. It's really what's happening in nominal spreads. Volatility has seen people looking to pare back some of those trades. I've even had people coming out and saying, why is the Aussie down on the back of what's happening in Omicron? We don't have it. We've got a couple of cases, but we're not obviously leveraged to what's happening in Botswana and South Africa. It started in the Netherlands by all accounts, but that's just because the Aussie dollar is a risk-associated currency in that situation. Have a look at volatility more broadly. This is just so important for me. Volatility defines the world. It is the most important variable in trading. Volatility defines what assets you're going to be trading, the direction that they're going to be trading. It can defines how much risk you're taking in a position. Of course, how much risk you take in a position defines your position size. So volatility or implied or realized volatility, and however you measure it, is the most important factor in trading. It is trading. And, in some capacities, some very smart people say that there is only one asset class, and that is volatility. Whether you want to trade volatility through optionality, straddles, strangles, collars, these factors, or whether you're just trading generic markets, you're trading vol. If you're short volatility, if you're long equities, you're short volatility. If you're long treasuries, you're long volatility. If you're long the Japanese yen, you're long volatility. If you're short, if you're long of oil, you're short volatility. So there is only one asset class in the world, and that's the way you've got to think about it. Anyway, so we're looking at rates volatility has been pushed up. You can see bond volatility on the Move Index is the highest since the pandemic, and even though it's not a million miles away from challenging pandemic moves there, and now you've started to see the VIX pushing up to 27%. So divide that by 15.9, and then you get your sort of implied daily moves over the coming 30 days. So it's good to see a bit of volatility back into the equity markets. We've seen that draw down. The question is, as we make into the turn of the new month, is that volatility going to stay with us going forward? That's the thing we've got to look out for. And we've got a bit of volatility. You can see that the G7 volatility index has picked up. So we've got volatility back in. Fantastic for us day traders. We love a bit of range expansion. We love a bit of life under the hood, and that's clearly happened. These are the perfect environment for me as a trader, but we are up against headlines, and that's something that scares the absolute bejesus out of me, having to go up against headlines. But let's have a look at those headlines, and let's have a look at the event risk that we've also got to look out for. I think that we've had a few people say, because of Omicron, does that mean that markets are not going to be sensitive to the data, or at least not as sensitive to the data flow? And I'm partially sympathetic to that view. Especially in light now of what Powell said to the Senate, where he has effectively come out and said that if the data continues to trend the way it's going, then we will have to accelerate our tapering program by an amount. Now, the market's already positioned there. We've been talking about this for weeks, but now it's good to hear the chairman effectively validate our view, and that's kind of it's heartwarming, makes us feel good about ourselves, and I think that's where we are now. So Jerome Powell's effectively said, if the labour market continues on its current trends, if inflation goes this way, and he's also said that inflation is no longer transitory, we can put that one to bed. Hallelujah, thank you for that. But what we now need to see to keep this side of the bargain, we need to see this data hold up. And then what we'll see in that Fed meeting in the 16th of December, which, again, I just come down to here. Let's have a look at it. There it is. You can see the Fed meeting on the 16th of December. That is going to be such a big event for markets. And, of course, that really depends on trends that we're seeing in Omicron, whether the vaccinations do prove to hold out effectively, and if that's the case, then this data will matter. And the one that we're looking at there is the US CPI number. I think that's going to be an absolute blockbuster. And I think, given what we saw from Powell, given what we've heard there, and from Murray Daly and some other Fed members as well, is if this data continues to be strong, and we do happen to see that the Omicron, the vaccinations do hold up and are effective, especially in the severe cases, then this data will matter. And what we're hearing on a retrospective basis will matter. And that Fed meeting will see huge increases to the Fed's economic projections. It will see a far quicker pace of tapering. And the dot plots are going to change quite markedly. So absolutely, we've got to look at payrolls this Friday. Have a look at payrolls. What are we expecting? 548 on non-farms. We're expecting the unemployment rate to drop to 4.5%. The labour force participation rate's one that I've been focused on very heavily, and you can see that 61.7%. It's going to stay fairly confined, and I think that's something that Powell's really been talking about. The idea that the participation rate may not go up to what they previously had assumed, and they've changed that mindset. So I think that's a big one there. But this data point, I think it in itself is less sensitive, because we're trying to model a world of what happens if the vaccines don't hold up. How does the world change if it becomes a bigger issue? How quickly can they get one? We know that they've been talking about it for being able to produce one by the beginning of next year. But these are the things we're looking at. Now, if we do see that Fed meeting accelerating, the biggest thing you can look at now is the bond market. Okay, I'm going to show you something that really is springing to mind right now, and it's good in some capacities for the dollar, but at the same time it's bad for risk assets more broadly, and it's probably why we're favouring the yen at the moment and Swiss franc. Have a look at the 2-year treasuries on the back of Powell. We've been seeing Treasuries sell off and we got up to 61 basis points. Then we saw some bids coming in the market. Omicron became a thing and effectively people reprice markets effectively. Now that's untrue. We're actually seeing selling playing through. You can see that, the 2-year Treasuries, the ultra short end of the curve is now trading at 60 basis points. So that's been moving up. But have a look at the long end that we've been seeing on 30-year Treasuries. You can see it just testing 179 on 30. So if this breaks materially to the downside, we see buyers play through, yields come down, then this flattening of the yield curve, especially on the long end, is telling you everything you need to know. I'm really quite concerned about what I'm seeing in various parts of the curve. We can have a look at 2s versus 10s. It's collapsing at the moment. The Fed will not like to see a rate hiking cycle into a flatter curve, but if that kind of thematic of what you see in the first place. Anyway, 2-year Treasuries tend to move up. But what I like about this, and what I think is quite interesting, is if you have a look at the euro-dollar curve, you can have a look at what's priced in for 2022. You can see the white line here. This is the interest rate market, 77 basis points. Going to 2023, and you can see 62 basis points. Go into 24, and we've got 10 basis points. Going to 25, and we've got 1 basis point. What this is telling us with flatter curves, 2 years going up, back end coming down, interest rate markets nearly pricing in rate cuts in 2025, is that rate hikes are expected to be front loaded. They're expected to be fairly aggressive, getting up to a terminal rate of about 1.5 to 1.75%. But in that environment, we're going to see slower growth. And we could see, if this goes negative into rate cuts, a policy mistake being priced in. And that's something that really, I think, is causing some material angst coming through in markets as well. So definitely something to watch. If that yield curve continues to flatten out as 30 years and 10 years continues to find buyers and the front end moves up, I think that's going to be something that will keep volatility very, very, very well bid going into year end, into the CPI numbers, into the debt ceiling debate, all these other factors playing through. Now, again, we're going to have a look at real rates. We can see gold prices dropping. We can see real rates are just stagnating a little bit there at the moment, but we are sort of moving a little bit higher, and that's keeping the dollar nicely in play there. In terms of volatility for gold, where you can see volatility in gold has picked up a little bit to 15%. That means greater expected movement up and down. And we can see that in terms of the risk reversals, you can see that the skew of call volatility is trading at a 0.49 discount to puts. So, the market is modestly negative in terms of gold, you could say, but the expected movement on the downside is probably somewhat slightly higher than the expected movement on the upside. I think that's but the semantics pretty neutral, I think, in that, and that's probably in line with what we're seeing in positioning as well. So back to our good friend, the charts. We're watching that yield curve. We're watching the front end of the curve. We're watching real rates. I think they're really important for sentiment in a lot of these markets. I'm watching what's happening in crude oil because we've got an OPEC meeting this Thursday, and oil prices have collapsed. You've seen them down 20% or so. What are OPEC going to do this Thursday? Are they going to come out and halt its production increase? I think that's a given, to be honest. But what else can they do to try and smooth this move? Keep an eye on crude at the moment. I think rallies are to be sold in this environment. But I think we are coming to a point where we may start seeing a bit of buying coming into the OPEC meeting on Thursday. And of course, we've got the inventory numbers that still need to come through as well. So I think that's a really interesting play that we've been seeing. I still want to keep an eye on the dollar. If the dollar continues to grind lower, that could be quite supportive of the gold price. Let's have a look at what's happening in those yield curves at the moment. But a fascinating time to be in markets. We are seeing this battle between what the Fed are talking about, what's happening in Omicron, a lot of assumptions being made in markets. It's keeping volatility high, fascinating times, but we've got to be trading headlines, and that's very difficult to do. At the moment, my stance is, as you've seen with the gold price, is to trade it when the price moves either way, and I think we want to try and start small positions and add as that works on. But, it really depends on what happens in real rates, what happens in the curves, and also, of course, what happens in the dollar. So we'll see you back next week.